Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney and founder of IRA Financial. And we got a good episode for you today. Got two questions from clients and one from Facebook. And the questions will cover IRAs and two 401k questions, which I think you'll find really interesting. So let's get right to it. First question is from Facebook. Can I gift my IRA to my child? So the answer is unfortunately no. You cannot gift an IRA to anyone. You are the beneficiary of your IRA if you're living. If you pass, then you could designate a primary or contingent or secondary beneficiary. The only way to provide money from your IRA to a child is take a distribution. If you're under 59 and a half, it's tax and a 10% penalty. If you're over 59 and a half, it's tax. If you have a Roth IRA, then if you're over 59 and a half, it's tax-free. If you're under 59 and a half, it's tax and a 10% penalty on top of the contributions. Roth IRA contributions, since they're after tax, can be taken out tax-free. So one, solution is if you're doing a Roth IRA, and let's say you've been putting in $3,000 a year for 4 years, and you have $12,000 of contributions, plus an extra, let's say $6,000 of appreciation, so $18,000 total in your Roth IRA, you could take out $12,000 up to it, at least tax-free, and gift it or give it to your child. That's a way to get tax-free money out of your Roth. However, if you had a pre-tax IRA, you couldn't do it, right? You'd have to pay tax and a 10% penalty on whatever you pull out. If you're over your RMD age 72, you can gift up to $100,000 to a charity, which can go up and cover the amount of your RMD. But it has to go to a charity. It can't just go to a child. If you want to give money to a child, you got to take a distribution. So unfortunately, I wish it was easier to do. Maybe the rules will change. But right now, you got to take a distribution to give money to your child from your IRA. Question 2 is from Jane E. of Richmond, Virginia. And Jane wants to know, I have a full-time job with a 401k plan, and I'm about to launch a Shopify business with my best friend. Well, cool. She does not have a 401k plan. Can we set up a solo 401k for our new biz? So the answer is yes, okay? As long as you have a business that does not have any full-time employees, over 1,000 hours, other than you and your friend. So there could be independent contractors, there could be people that work less than 1,000 hours. They will not be deemed employees. And then yes, you can set up a solo plan for your Shopify business. Now, your friend, if this is his or her only, I guess it's her, it says she. If this is her only job, then yeah, she can contribute up to $19,500 or $26,000 if she's over 50. And then you can also do a profit sharing of either 20 or 25%, depending on how your business is set up. 25% if it's a corp of your W-2, 20% if it's an LLC, single member LLC, or if it's a multiple member. Guaranteed payment, it would also be 25%. So in your case, you're probably looking at 25% of your W-2 or guaranteed payment. So if your friend made $50,000 through her Shopify business, she'd be able to put in, if she's under 50, 19.5 plus you can go all the way up to 25% of 50. Now let's talk about you, Jane. If you have a job at your full-time job, if you have a 401k, at your full-time job, you can put away 19.5 or 26 if you're over 50, plus any profit or safe harbor contributions the company does. Now, if you don't max out, if you don't put in the full 19.5 or 26, you can make up the difference on your Shopify plan. If you do max out at your full-time job, then all you'll be able to do is profit sharing. Meaning, let's say you put in 19.5 at your full-time job in Richmond or anywhere else you work, then all you're going to be able to do at Shopify is the 25% of your W-2. If you don't make a W-2, you're not going to be able to put in anything in the Shopify business, but your friend will, so long as she makes money. So that's kind of the answer. It all depends on what you're maxing out or how much you're putting into your company, full-time job, 401k, and then it will depend on how you guys are going to take income, W-2, since it's a solo plan. Are you going to have employees? If you're going to have employees, you won't be able to do a solo plan. Maybe you want to do a SEP, since there's a 3 out of 5 year rule where you only have to provide benefits if employees work 3 out of 5 years, or you just want to do a regular 401k or a simple IRA. You got some options. If you're not going to have any full-time employees, you're going to outsource most of the distribution, through Shopify network, packaging, things like that, marketing. Then if you take W-2, you can put in any difference from your full-time job net of the 19.5 or 26, and then also profit sharing. And then your friend could also put in the money. So it could be a really cool option for you to put it away more than the maximum of 19.5 or 26 into the Shopify business 401k. Third question is from Kevin G. of Louisville, Kentucky. Kevin wants to know, I have a 401k plan at work. I'm 49 years old. I want to use some of my 401k plan to start a business with my wife. What is the best way of doing this? So another business owner, love to see the entrepreneurship, really cool. I think one of the silver lines of COVID is you see more and more people saying, hey, I want to work at home. I want to be my own boss. I want to take advantage of freedom, and I want to start my own business. So I think you're going to see a lot more people enter the gig economy, and I think you'll see a trend there. So this is a really good question. So what are your options? If you have, Kevin, money in your 401k, which you mentioned you have a 401k, since you're under 59 and a half, you're generally not going to be able to touch that money. I know it's hard to believe. I know it sucks. With an IRA, you could, right? You'd have to pay tax and a 10% penalty. If it's a pre-tax IRA, if it's a Roth, you'd pay tax and 10% penalty on any appreciation above the contributions you made. Contributions can always be pulled out tax-free. But unfortunately with the 401k, there's different rules. So you're kind of locked in. The only way you get money out is if you can argue hardship, whether it's like medical, financial, things like that, or if you leave your job. Okay, if you don't want to leave your job, then the only other option you're going to have is a loan. So if your 401k at work has a loan feature in the plan, then you'll be able to borrow $50,000 or 50% of your account value, whatever's less. So if you have 100K in your 401k, you'll be able to borrow 50. If you have 40 in the 401k, you'll be able to borrow 20. If you have $1 million, you're only going to be able to borrow 50. Now, the good news of this is it's a loan. You're paying your plan back. So the interest is going to you instead of a bank. So that's pretty cool. And you can go up to, again, 50K or 50% of your account value, whatever's less. You can use the funds for any purpose, whether it's investing in your own business, paying off a mortgage, rent, going on vacation, buying your spouse a diamond watch, ring, whatever. You can do whatever. You can bury the cash under your in your backyard. You can do whatever you want. Rules are it's a 5-year loan, payable at least quarterly, at an interest rate of at least prime, as per the Wall Street Journal, which is 3.25% as of June 2021. And it's a straight line loan. No balloon payments. Everything is straight line. So the interest and principal is combined. Okay. So it's a pretty cool thing because you get tax-free, penalty-free. So that money, Kevin, you can use it for any purpose. And best of all, you're paying yourself back. So that 3.25% interest. And yes, you can go even higher if you wish, 4, 5, 6, 8, 10%. And then you're basically generating returns on that money you're using for your business. And then you can use that money, again, tax-free, penalty-free, start your business with your spouse, and you just have to make sure you can pay back that loan, because if you don't, it's considered a taxable distribution on any outstanding amount of the unpaid loan. So you definitely want to plan accordingly. Some employers will let you pull that money from your paycheck to pay the loan. Others, you can just kind of pay back from other sources. Talk to your employer, talk to your plan administrator. But it's a really cool option to get some tax-free, penalty-free use of some 401k funds. Because ultimately, if you're not quitting your job and you're under 59 and a half and you have no hardship, that's it. Like, that's really your only option. Now, if your spouse has an IRA or 401k funds, maybe you have some other options. There's something called a ROBS, a rollover business startup solution. It lets you use all your money if you had access to it. Let's say you were over 59 and a half. You can do a ROBS and then use a C Corp that adopts a 401k. You roll the IRA or 401k funds tax-free into the new 401k, which invests in the business. So now you have a business with cash in it. You can be an employee. The 401k owns most of it, which will give you tax-free dividends and tax-free capital gains on any sale of the company stock. And then you can use the money tax-free, penalty-free above the 50K threshold for the loan and use it for any purpose, including starting a business. So Robs have been super popular in the last, 10, 15 years. I wrote a book on it. You got to make sure you're using a corp 401k. You also got to make sure you're working with experts that know how to custody and administer the 401k and do all the record keeping, keep the plan in IRS compliance. Make sure you're buying common stock. Make sure you're doing everything you need to follow the exemption under 4975 D13 that allows a 401k to buy qualified employer securities, which is C Corp stock. So, that's something you just need to be aware of, Kevin, and just not seemingly an option for you because you're under 59 and a half and you're not going to have access to all your funds. But I just kind of want to throw it out there for anyone else listening that may be in a situation where they have access to their 401k funds, or maybe they have an IRA that they can do a tax-free rollover to a 401k and then use the ROBs for the 401k to buy stock in this corp. And then you can use the money to buy the business, whether it's a franchise or a startup or whatever it is. And then the good news is, again, your 401k owns it, so you can sell the stock. All the gains go tax-free back to the 401k. You can also earn a salary, run this business as you would any other business, but you need to have a C Corp, not an S Corp, and you need to use a 401k and not an IRA. And we got tons of info on our website if you're looking for more info on the ROBs. But again, if you need less than 50K, the 401k loan feature is a great option because it's super quick, it's easy, tax-free, penalty-free use of the money. You don't need to use a C Corp. You already have your 401k and you're paying yourself back, right? Instead of getting a bank loan, that 3.25% interest payment or whatever interest rate you decide to use will go back to your 401k without tax. So it's kind of like a win-win, right? You get tax-free, penalty-free use of the cash and you are paying yourself back at a decent interest rate. 3.25% is not a horrible return in a zero interest rate environment. It's not horrible. It's not amazing. It's not horrible either. So it's kind of a cool solution for you, Kevin, because it seems like you're just not going to get access to those funds since you're under 59 and a half and you still seem to be employed at your job. If you quit, then yeah, you'll get access to those cash and then you could do a ROBs. If you do an IRA, you got to be careful about investing in your business with your spouse because it will likely trigger a prohibited transaction. Just dropped a podcast on AdBits about the 401k prohibited transaction rule. So if you're interested in learning more about the 401k prohibited transaction rules, you can always check it out on our YouTube channel. Also, a podcast that just dropped earlier the week. So, but again, there may be other options, whether it's the ROBs, or maybe you set up your own solo K with your wife, roll the funds tax-free into your new solo K, and either do a ROBs or another loan through it. So you got some options, Kevin. That's kind of what I'm trying to say. So there you go. Another great week for ADMAIL. 3 super questions. Keep the questions coming. I got a queue of questions that I promise I will get to, but send them in to info@IRA Financial. You can just subject, ADMAIL or Ask Adam. And love to hear from you. You can also drop questions on YouTube, Facebook, Twitter, Instagram. And I will add it to the queue, and I promise I will do my best to get to all these really, really great questions. So thanks again for listening. Subscribe if you haven't. Give us a like. Drop us a like. I really appreciate it. And otherwise, stay safe, stay strong, and talk to everyone again next week.